Tax arbitrage. What is the idea of tax arbitrage? The idea of tax arbitrage is that you incur an expense, but you could write off more than the actual expenses that you incur. So you have $1 worth of expenses, but you could write off $5 off your taxes. How is this possible? There are many ways of doing it. Let me first get my compliance out of the way. I am not licensed to give tax advice. This should not be considered personalized tax advice for you. I'm just giving general information, and you should, of course, consult a qualified and licensed tax professional before making any decisions, because obviously all of these are specific to you, and taxes are just one component of your overall financial strategy. There actually are scenarios where you might want to pay more in taxes in various cases because we'll put you in a better situation overall. As an example, I deal with real estate investors where they pay very little in taxes because they show very little in income on paper, which is great, until you go to a bank to try and get a loan. And then all of a sudden, the real estate investor cannot qualify because the income he's showing is so low. And so in that case, what the real estate investor might decide to do is to not take as many deductions, pay more in taxes so he can show a higher income and therefore qualify for some of these bank loans, as an example, a first lien HELOC. So I'd help real estate investors with that. It becomes a pretty easy choice to the investor. You'll pay X amount extra in taxes this year in order to qualify for this first lien HELOC. Is that worth it? In most cases, the answer is yes. So we go ahead and pay more in taxes today in order to get access to this financing vehicle that can then be used over the next 10 to 30 years to purchase a lot of great real estate properties. But how does tax arbitrage happen? Let's give a few examples. What would be a very simple, easy one is mileage on your car. So if you have a car and you use it for business purposes, you can write off the mileage. This is assuming it's a car that you personally own. It's not the car that your business owns. So you use it for both personal and business. So you're just writing off the mileage that you use it for business purposes, not for person. You can write off the mileage, and the IRS sets the mileage rate every year. So this year in 2025, I believe it's 51 cents. So you can write off 51 cents per mile that you drive your car. And if you have an older, very reliable economy car, the cost to you to drive that car is probably not 51 cents per mile. It's probably significantly less. Maybe the cost to you is really only 10 cents per mile to operate your vehicle, but you could write off 51 cents because that's the standard IRS mileage given. So that's just one simple, easy example of where you can incur an expense and write off more than your actual expense. Another would be when it comes to policy loans against whole life insurance. So if I borrow against my whole life insurance policy, I take out a policy loan, I am being charged interest by the insurance company. Let's say it's 5%. If I use that loan for business or investing purposes, that interest cost becomes a tax-deductible expense. So I can write off 5% in interest because I'm using that loan for business or investment purposes. But is the actual cost of borrowing to you, is it actually 5%? Is it actually 5%? Remember, the cash value in your policy is still growing while you're borrowing against it. So what is your real cost to borrow? Your real cost to borrow is the policy loan interest rate minus whatever you're earning in the policy. So let's say I'm borrowing against the policy at 5%, but I'm earning 4% in the policy. Then my real cost of borrowing is 5% minus 4%, which is 1%. So really, I'm only paying 1% net in borrowing costs in interest, but I can write off 5% because that is the interest I'm being charged. Just the same as if I'm a real estate investor and I borrow against my property. Let's say I use a home equity line of credit and I borrow against my property. I'm paying 8% interest on that home equity line of credit, and I use it to buy another property. I can write off that full 8%, regardless of the fact that the property that I'm borrowing against is giving me benefits. So I'm paying an 8% interest rate, but maybe the property I'm borrowing against is appreciating in value at 5% per year. Plus, I'm getting rental income from that property. It doesn't matter. I don't have to discount that 8% by the benefits I'm getting from the property. I can still write off the full 8%. So I can write off 8% interest because I'm borrowing at 8% and I'm using the proceeds for business or investing purposes. So those are just a couple of examples of what we call tax arbitrage. And there are lots of different tax strategies that can be applied. I'm hoping to do more content on taxes because I just think it's a very overlooked field that has a lot of opportunity for improvement, some of which can be helped with a whole life insurance policy, but that's just one tool in the toolbox. There are many other ways that you can reduce your tax burden. I think this is something that wealthy people and high income earners pay more attention to because the higher your earned income, the higher your tax bracket, generally speaking, the more wealth you have, the more you're concerned about taxes. But your average person, I don't think, gives taxes the attention that they really should, because even for your average person, I think there are ways you can get more tax efficient. So if you're willing to get a little bit more creative, by the way, a lot of these strategies depend on you and how much work you're willing to put in. How much work are you willing to do? The amount of work, in my opinion, is incredibly low, incredibly reasonable relative to the benefits you're going to realize, which could be in hundreds of thousands of dollars of tax savings over multiple years, even for an average person. But what you might do is look at expenses you're incurring on a regular basis in your personal economy and ask yourself, is there a way I could turn this activity into a business or into a nonprofit? Look at all the expenses in your personal economy. Look at all the activities that you're doing, all the hobbies that you have, all the activities that you're doing anyway, and think about, is there a way I could turn this into a tax deduction? Maybe you're the sort of person who's charitably inclined and you're already doing charitable work. Maybe you can start your own little nonprofit and turn that activity into a tax deduction activity you're doing already. Maybe you have a hobby and that hobby is something you really enjoy and it costs you, let's say, $20,000 a year. Maybe you like mountain biking. Maybe you like skiing, whatever it might be. There's probably a way to turn that into a business or maybe a nonprofit and at least turn those expenses into tax deductible expenses. So maybe my side gig that I set up doesn't make me a lot of money. Maybe it makes me an extra $10,000 to $30,000 a year. That's still a meaningful amount of money. Once you include all the tax benefits I'm getting, maybe an equivalent benefit to me is more like $50,000 or $60,000 a year. Once you include all the tax benefits, because now so many of these expenses that I'm incurring anyway now become tax deductible expenses. I, as a business owner, now think this way. Any expense that I have, I'm always thinking, how can I try and turn this into a justifiable tax deductible business expense? So a simple example would be anytime you're traveling, even if you're just driving to a local place, anytime you're going anywhere, local or further away, do some business activity. Find a way to turn it into a business trip. Bring your business cards with you. Bring whatever business collateral you would typically bring with you and do some prospecting, do some presentations, whatever it is that you do in your business. And now you can find a way to write these trips off as business expenses. That's just one example. Think about all the lifestyle expenses that you have and think about, can we turn those into a tax deduction? And I like thinking this way because most people, when they think about their finances, they're only thinking about investing. And that's it. They ignore 80% of their financial life, which is the money that they're spending. And they just focused on the 5, 10, 20% of money that they can save and ask, what vehicle can I put this in where it's going to grow at a competitive rate? Okay, you can do that, but instead of focusing on the 10% that you're saving, why don't we back up, focus on the 90%, everything else that's going on in your financial life? What if we can get you better protection so you have more peace of mind? You can make better financial decisions and you'll be protected in a lot of negative scenarios. What if we can find ways to increase your cash flow? One of them would be spending money in a more tax efficient manner so you're not losing as much money to taxes. What if all these purchases that you're making, we could find more effective ways of financing those purchases so you start getting some of that money back? The list is endless, and these are low-risk things that we can do. We're not taking on any market risk, and they have immediate, concrete impacts, and they can have dramatic impacts over the long run, where we can free up another 10, 20, 30% of your income by doing strategies like these.